Financial markets are chaotic, adversarial systems. If you want to predict an asset's movement, you can't just look at a price chart. You have to ingest a massive, continuous stream of interlocking data, from macroeconomic indicators and raw volume to breaking news headlines and social media sentiment. Traditional, rule-based quantitative models struggle in this environment. They excel at processing clean numbers, but they fail when forced to interpret qualitative, unstructured information, like the tone of a CEO's speech or a sudden panic on a retail trading forum. Deep learning algorithms were introduced to bridge this gap, but they created a new problem, the explainability crisis. These models operate as opaque black boxes. When an algorithm executes a massive sell-off, human auditors have absolutely no way to look under the hood and understand the reasoning behind the trade. Recently, developers turned to large language models. Because an LLM is explicitly designed to process text, it seems like the ideal tool to parse thousands of financial reports and news feeds. But feeding all this information into a single LLM agent causes the system to buckle. The sheer volume of data overwhelms the model's context window. Over a long trading horizon, the agent starts forgetting earlier instructions and degrading its own output. When forced to balance inherently contradictory signals, like bullish technical indicators against bearish macroeconomic news, a single agent gets confused. It loses the analytical threat, invents facts, or simply hallucinates a decision. To build an AI capable of algorithmic trading, we have to abandon the black box nature of deep learning and the memory failures of single-agent LLMs. The solution requires an entirely different architectural approach. Researchers from UCLA, MIT, and Toric Research recently published a paper outlining a new system. They call it the TradingAgents framework. In empirical testing on highly volatile tech stocks, this framework generated a 26% cumulative return and a Sharpe ratio exceeding 8, heavily outperforming market baselines. This architecture diagram illustrates organizational mimicry. The AI is structured like a multi-department trading firm. By dividing the workload among specialized nodes, analysts, researchers, and risk managers, the system compartmentalizes context. No single model holds the entire market state. Mimicking a corporate structure is a direct engineering mechanism. It distributes the cognitive load across multiple models, solving the multimodal complexity problem without collapsing a single context window. Let's break down how this architecture operates, starting at the data ingestion layer, the analyst team. This tier runs 4 concurrent domains of expertise. A fundamental analyst evaluates financial statements. A sentiment analyst scrapes social media. A news analyst monitors macroeconomic events, and a technical analyst tracks price action and momentum indicators. Gathering this data presents an immediate engineering bottleneck. If you deploy a heavy, deep reasoning LLM just to pull data from a web API, you introduce massive latency and exorbitant compute costs. The framework uses task-specific LLM routing. Fast, lightweight models like GPT-4o Mini handled the low-depth task of retrieving raw API data. That data is passed to dedicated deep thinking models like O1. These apply advanced reasoning to synthesize the raw feeds into clean, formatted analysis reports. This bifurcated approach allows the system to ingest massive amounts of data efficiently. It optimizes for both speed and compute cost, while preserving the analytical rigor required for the next phase of the process. Those completed reports are then passed up to the researcher tier. This layer acts as a critical filter, ensuring that a single positive metric doesn't trigger a reckless, unverified trade. The architecture accomplishes this through a dialectical debate. The analyst reports are fed simultaneously to 2 opposing AI researchers, one programmed with a bullish perspective and the other with a bearish perspective. They are forced to argue the merits of the trade. In standard setups, open chat rooms cause the telephone effect. As history grows, the system state corrupts. Agents hallucinate and forget parameters. TradingAgents fixes this by enforcing a structured communication protocol. The agents cannot chat. They must pass rigid, unidirectional, structured text reports to one another. Natural language is heavily quarantined. It is only permitted inside an isolated subroutine, a strictly constrained, multi-round debate loop between the bullish and bearish researchers, which is actively overseen by a facilitator agent. Locking down the communication pathways and forcing agents to read from structured state documents prevents the context window from filling up with conversational garbage. This protocol allows the agents to maintain logic and precision over extended trading horizons. After the debate concludes, the winning perspective is formatted into another report and handed to the trader agent. The trader synthesizes all this data and outputs a specific transaction proposal. In a standard system, this is where the trade executes. In TradingAgents, the order is intercepted by an independent risk management team. This tier is composed of 3 distinct subagents, each programmed with a specific mandate: an aggressive risk profile, a neutral profile, and a strictly conservative profile. These 3 agents enter their own quarantine debate. Their sole function is to vet the trader's proposal, checking the proposed volume and timing against the firm's strict exposure limits and maximum drawdown tolerances. Only when the risk team reaches a consensus do they output a finalized adjusted report. This document is passed to the final node, the fund manager, which formally authorizes the execution in the live market. This sequence translates the real-world safeguards of an institutional trading desk into strict code, forcing the AI to survive multiple layers of adversarial vetting before a single dollar is put at risk. To test the validity of this architecture, the researchers ran a rigorous backtest through the first quarter of 2024, strictly restricting the agents to historical data to eliminate any look-ahead bias. This chart illustrates the cumulative returns for Apple stock during that volatile period. The top brown line represents the trading agent's framework. As you can see, it completely detaches from the flat, clustered lines of traditional momentum algorithms like MACD and RSI. When evaluating trading algorithms, there is typically a harsh trade-off between risk and reward. Traditional baseline strategies successfully minimized the portfolio's maximum drawdown, but they failed almost entirely to capture the stock's upward price swings. The multi-agent approach flipped this dynamic. The system identified the correct entry points to capture over 26% in upside returns. Simultaneously, the internal risk tier effectively constrained downside exposure, keeping the maximum portfolio drawdown below 2%. The empirical results confirm the thesis. Forcing large language models into adversarial debates generates verifiable financial returns while tightly managing market risk. Looking closely at the daily transaction log, we can see exactly when the model decided to act. The green and red arrows verify the system's ability to consistently time its long and short positions against the daily price action. Remember the primary issue with deep learning quant models. When they make a decision, good or bad, they cannot tell you why. The data goes into a black box and a trade comes out. TradingAgents uses a prompting structure known as the React framework. This forces every single LLM node in the system to explicitly log its internal reasoning, its tool usage, and the complete text of its debates directly into the global state. As a result, the system automatically generates a comprehensive, plain-text paper trail. A human researcher can audit the exact chain of logic, down to the specific analyst report that justified a multi-million-dollar short position. We do not have to accept opaque black boxes in quantitative finance. By constraining language models within rigid organizational architectures and strict communication protocols, developers can build trading engines that are both highly profitable and fully auditable.